All right, if you follow markets at all, you need to hear this. Hit like right now, settle in for a second, because something big just happened and most people are completely misreading it. We just watched a brutal crash rip through precious metals, billions wiped out, sentiment crushed in days, not months. And right when everyone assumed the smart money would back away, China didn't stop. They kept buying gold, silver, physical supply. That's the part that matters right now. Stay with me because I'm going to walk you through what's actually happening under the surface, how to recognize this pattern when it shows up again, and why this divergence after a crash is often where the real opportunity quietly forms. If you're watching this now, you're ahead of most people who are just reacting to headlines instead of understanding what's actually moving. Before I explain what caused this, let me teach you something most people don't really understand about markets. Prices don't always move because of fundamentals in the moment. Sometimes they move because positioning breaks. Think of markets like a crowded theater. Everyone's sitting calmly until someone yells fire. When that happens, it doesn't matter who actually believes there's a fire. People rush the exits anyway. That's what violent retracements are. They're about forced selling, margin calls, and paper leverage snapping. Meanwhile, the people who actually want the asset, the ones planning to hold it for years, they don't care about the noise. They care about inventory. They care about long-term protection. And they often use chaos as cover. So what does that tell us? It tells us that price action alone doesn't tell you the whole story. You've got to watch who's buying when everyone else is panicking. That's where the signal lives. If this is making sense so far, drop a comment below and let me know you're following along. Your engagement actually helps this reach more people who need to see it. Now here's what's actually happening. Let me break down the sequence in plain language. Western futures markets sold off hard. Paper gold and silver contracts got hit as risk came off across everything. Funds needed liquidity, so they sold what they could sell fast. That pushed prices down aggressively, creating this cascade effect where stop losses triggered more selling, which triggered more stop losses. It's mechanical. It's not some grand conspiracy. It's just how leverage works when it unwinds. But at the same time, and this is critical, China's central bank kept adding gold to its reserves, extending a streak that's now over a year long. No pause, no hesitation. That tells you something important. They're not trading price, they're accumulating strategy. And in silver, it gets even more interesting. Physical demand inside China stayed elevated, both retail and industrial, even as futures prices dropped. You've got retail buyers stacking coins and bars. You've got industrial users who need silver for solar panels, electronics, 5G infrastructure. That demand didn't just evaporate because paper traders got scared. Add new export controls that kicked in at the start of this year, and suddenly local supply tightens while global paper prices fall. Here's what's wild about that. When physical demand refuses to follow paper selling, pressure builds. It doesn't always resolve immediately, but historically, it doesn't resolve downward forever either. Think about what happens when you've got less physical metal available for export, while global buyers still need it. That creates a gap. That gap has to close somehow. Either price adjusts higher, or supply finds a way to increase, or demand finally breaks. Right now, demand's not breaking. Supply's getting tighter, not looser. So which variable do you think gives first? And here's the part that should make you nervous if you're ignoring it. This divergence is usually invisible right before it matters. By the time everyone sees it clearly in the data, the opportunity's already moved. You're late. The people who position ahead of obvious confirmation are the ones who actually benefit. I'm not saying you should blindly rush in. I'm saying if you're waiting for perfect clarity, you're probably waiting for someone else's exit liquidity. Let me show you something else that's not getting enough attention. Silver inventories at major exchanges have been trending down for months, even before this recent crash. We're talking about registered silver, the stuff that's actually available for delivery. That's been declining while open interest in futures contracts stayed relatively high. What does that mean in simple terms? It means there are more paper claims on silver than there is silver sitting in vaults ready to be delivered. Now, most of those contracts never go to delivery. Traders just roll them or cash settle. But when stress enters the system, when someone actually demands physical, that's when you find out if the metal's really there. And based on what we're seeing with inventories, there's less cushion than there used to be. Zoom out for a second because this isn't new. This is the exact same playbook we've seen before. After the 2008 crash, gold didn't bottom the day panic peaked. It bottomed when forced selling ended and physical buyers stepped in quietly. I remember watching that happen in real time. Paper gold got crushed alongside everything else in September, October of 2008. Everyone was selling to raise cash. But by late 2008, early 2009, central banks and sovereign buyers started accumulating. Gold didn't make new highs immediately. It took time, but from that bottom in late 2008, gold more than doubled over the next 3 years. Same pattern. Paper breaks first. Physical asserts itself later. After the 2020 liquidation, silver collapsed first, then doubled once supply constraints became undeniable. March 2020, everything sold off. Silver dropped from the mid-teens to under $12 in a matter of days. Brutal. But by summer of that year, industrial demand came roaring back. Mints couldn't keep up with retail demand. Supply chains were disrupted. Silver went from under $12 to nearly $30 in less than a year. Every time this has happened, the common thread is the same. Paper markets break first. Physical markets lag, then assert themselves. When you look at the pattern over decades, sharp retracements paired with sustained sovereign accumulation have rarely marked the end of a bull cycle. They've marked buying opportunities for people who understood what they were watching. The larger story is this. Structural demand doesn't disappear just because traders get scared. It persists, it accumulates, and eventually it reasserts itself in price. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could China stop buying tomorrow? Sure. Could official data lag reality? Absolutely. We don't get real-time transparency into what the People's Bank of China is doing. We get monthly reports, sometimes with delays. And yes, not every divergence leads to an immediate upside explosion. Markets can stay messy longer than anyone expects. Sometimes divergences resolve sideways. Sometimes they take months to play out. Could this be manipulation? Could Western banks be suppressing prices while Eastern buyers accumulate? Maybe. Honestly, it doesn't actually matter whether there's some coordinated scheme or not. Here's the thing about manipulation claims and panic narratives. They distract you from what you can actually observe. Flows, inventories, policy behavior. You can't control headlines. You can control whether you're watching the right signals instead of reacting emotionally to price alone. Focus on what you can verify and what you can act on. Everything else is speculation. There are probably 3 types of people watching this right now. Maybe you're already positioned in metals, and that crash rattled you. You saw your portfolio drop hard and fast, and now you're wondering if you made a mistake. If that's you, your job isn't to predict tomorrow's price. It's to ask whether the long-term thesis actually broke. Did fundamentals change? Did China stop buying? Did industrial demand collapse? Did central banks suddenly announce they're selling reserves? So far, none of that happened. What happened was a technical washout driven by leverage and forced liquidation. If your thesis was based on long-term monetary debasement, sovereign accumulation, and supply constraints, ask yourself honestly if any of that changed. If it didn't, then maybe this isn't the time to panic. Maybe it's the time to reassess position size, sure, but not abandon the strategy entirely. Maybe you're skeptical and sitting in cash, waiting for confirmation. That's fair. Your edge is patience. You don't want to catch a falling knife. You want to see evidence that the selling's exhausted before you commit capital. I respect that. Watch whether physical premiums stay firm even as paper prices drop. If premiums widen, that's physical demand asserting itself. Watch whether China's central bank accumulation slows or accelerates in the next few reporting windows. Watch whether silver inventories at exchanges continue declining or stabilize. Those are your confirmation signals. Don't rush, but don't ignore them when they appear either. Or maybe you're new, just trying to understand why anyone cares about gold and silver at all. If that's you, focus on learning this one lesson. When physical demand ignores paper selling, pay attention. That principle applies to everyone, no matter your strategy. It applies to metals. It applies to commodities. It applies to any asset where there's a split between paper derivatives and physical delivery. When the two diverge significantly, something has to give. Learning to spot that divergence early is a skill that'll serve you across markets. That mentality, that willingness to look deeper than surface price action, will serve you well. So here's what I want you to answer in the comments. Which type are you? Are you holding and reassessing? Are you waiting for confirmation? Are you new and trying to learn? Let me know, because I read these and it actually helps me understand what content to create next. So here's where I stand. I'm not panicking and I'm not blindly bullish either. I'm observant. Let me tell you what I'm personally watching. First, I'm watching whether China's official gold additions continue through the next reporting window. If they pause, that would change my view on sovereign demand momentum. If they accelerate, that confirms this is strategic accumulation, not just opportunistic buying. Second, I'm watching physical silver availability and premiums relative to futures prices. If premiums start spiking while paper prices stay flat or drop, that's physical demand overwhelming available supply. That's been a leading indicator historically. Third, I'm monitoring volatility itself, because collapsing volatility after a spike often signals exhaustion. When the VIX equivalent for metals settles back down and stays there, that tells you forced selling's probably done. Fourth, I'm keeping an eye on industrial data out of China and other major manufacturing hubs. If industrial demand holds firm while financial selling happens, that's another layer of support under the market. Based on my analysis, this crash was mechanical, not fundamental. The fundamental picture hasn't changed. You've still got central banks globally holding massive amounts of debt. You've still got fiscal deficits that aren't shrinking. You've still got geopolitical tension driving demand for reserve diversification. You've still got industrial applications for silver that are growing, not shrinking. None of that disappeared because futures traders needed to raise cash. If history rhymes and physical demand continues while paper selling exhausts itself, the move that follows could be significant. I'm not making specific price predictions. I don't know if silver goes to 120 or 150 or where gold settles. But I know that when you get forced liquidation creating a gap between paper and physical, that gap tends to close eventually, and it usually closes in favor of physical. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Look at the inventory numbers, track central bank purchases, watch the premiums, make decisions that make sense for your situation, your risk tolerance, your time horizon. Don't just take my word for it or anyone else's. If you made it this far, you're the kind of person who thinks independently and wants to understand what's actually happening instead of just reacting. That mentality will serve you well, not just in this situation, but in every market environment you encounter. If you found this valuable, share it with someone who needs to see it. Subscribe if you want more analysis like this when these patterns show up again. And stay ahead by focusing on what matters instead of getting swept up in the noise. This crash wasn't random. It was mechanical. Leverage unwound. Fear did the rest. The fundamentals didn't disappear. Stay sharp out there. Think critically. Verify the data. And make decisions that make sense for you, not the crowd.